I should have argued that we should be lower today because of the weekend. Like so whatever the situation has been handled, we are good to go kind of thing.
Yeah.
Which should, send S&P 500 higher, and that's Friday move, isn't it? So it kind of did, but it kind of didn't. So what does that tell me? That tells me since we are still elevated and we haven't dropped down, there's still risk in the market. So that goes into your risk assessment of your when you're taking a trade is not necessarily what is VIX doing, but what is the risk in the market more than just you seeing. Because as I said earlier, we were not dropping hard on Eurodollar on open. That tells you that whatever Friday was, whatever the weekend was, wasn't a complete crash down of the market.
Yeah.
So since VIX is higher, Euro is higher, it's just higher volatility. Okay, that makes me maybe either reduce my lot size or expand my stop loss, or not necessarily not taking the trade, but being aware of, okay, mentally, if it hits stop loss, it's actually okay. It's actually a bit more randomness to your trading.
Sure. Well, Ivan, we've run out of time. I want to thank you for coming on. We have to kick ourselves out of here. But before we do that, let me just remind everybody, if you enjoyed Ivan's commentary, he has his own YouTube channel. He also does coaching calls within our Discord server. You can find him on YouTube at IvanFX. You can search him up. We'll also drop the link to his channel in the chat here while we speak. So do me a big favor, go subscribe to him. You can also reach out to him about one-on-one coaching. And if you're a member of our Discord community, send him a direct message about that coaching. He might have something special for you. So with that said, Ivan, thank you very much for coming on.
Thank you for having me.
All right. See you, Ivan. Okay, guys, I also just want to mention we're about to bring on Chris Pulver for the next part of our show, but let me just remind you, this week we are doing a 35% off discount on the Edge Finder. If you have not already heard, get yourself a copy for a super low price right now. We had a couple of giveaways the last few weeks for the Edge Finder, and now we had a lot of people explore the tools and express interest in it, so we are offering discounts to people who would like to try it out. We're calling it a bit of our spring sale here. Springtime is trying to come out, man, although it's pretty cold this morning where I am. I don't know about you guys. Anyways, 35% off on the Edge Finder is available right now. If you've been waiting for a chance to pick up a copy, now is your chance. Send us a direct message on the website. You can speak directly to our support team using the chat in the description and in the chat here below. When you click that link, just to show you what that looks like, you'll speak directly with a real person. Sometimes people come on to our chat and they say, am I speaking to a robot? No, you're speaking to a real person on our team. So if you would like some information about the sale, please click Edge Finder 35% off sale and speak directly to a member of our support team. Up next, we got Chris Pulver coming on to the show. Stay tuned.
Hey everybody, thanks for tuning in to today's A1 trading session. We love engaging with our audience, talking shop, taking requests, and sharing our favorite setups. It's about that time where we're going to review a bunch of indexes, stocks, currencies, gold, silver, Bitcoin, and pretty much anything else and share our insights. If you're wondering what trades I'm in, if you're wondering what trades I'm taking, and you'd like to see exactly how I'm trading everything, you can actually follow my trading signals. If that sounds like something you're interested in, we'll share a link in the chat. You can sign up. You can sign up directly with the link or speak to a support rep if you have any questions. If you're asking, what do I trade? Pretty much everything. Indexes, ETFs, stocks, options, futures, Forex, and crypto. Thoughtful analysis, active trading. Check it out. And now, back to the show.
All right, we're back with Chris. Hey, Chris, how's it going, man?
Good, Nick. How are you, man? How was the wild Friday to today? What are you feeling on this? I'm sure you saw the AAII. You posted that in Edge Finder.
Yes.
One of the most bearish readings I've seen since a actual bear market. Crazy amounts of sentiment swings we've seen this year.
I'm glad you brought that up because I wanted to discuss that. I also broke it out into two other unique charts. I think it can sometimes be a little hard to look at all at once. So I broke it into two segments. This is your bullishness. This is your bearishness. As you pointed out, look at the bearish sentiment. So for those who don't know, the AAII Investor Sentiment Survey is a weekly report that shows a huge number of respondents' perspective on the markets. Are they feeling bullish? Are they feeling bearish? Are they feeling neutral? Last week, Ivan was just on. We were discussing this big sell-off that we saw. And now, as you mentioned, Chris, we have 60.6% of respondents saying bearish. I mean, my perspective on that, Chris, is look, I'm a little cautious on the market myself, but we have to remember this came out. When did that come out? Thursday?
Yep. Worst day. Like Wednesday, Thursday was a terrible plunge. 6 days red. It's like I understand why the sentiment was deteriorating.
Yeah.
But
so that's my thought is, so guys, this 60.6%, this huge bearish spike in sentiment, when did that occur on the chart? Well, it occurred right here on this big sell-off day. Sure enough, market completely reversed on Friday and has followed through a little bit here today. But here's you asked me my take on it, Chris. My take on it is, look, if everybody's getting one side of the boat, I want to be cautious all the time. But I also think there's a possibility that we worked off a little bit of that oversold kind of nervousness. And I still remain kind of cautious myself. In fact, I kind of lean bearish in the short run for indices with just everything that's going on. I think longer term, it's a buy the dip opportunity. If we get a sell off down to 5,700, look, I'm going to be accumulating shares on stuff that I like. But what are your thoughts? Different? Same?
No. So I put in a couple of trades that are, well, here's a good example. I just ran an 11-year study, and I just soaked in a bunch of stuff this weekend where it's kind of like rehashing some of the strategies that I typically trade. All I did was I made a couple tweaks to the volatility index, and I ran a study where basically anytime the VIX is over 20, can I sell premium? And should I sell premium? And how do I sell premium? So it's a delta neutral or a kind of directionally neutral strategy. But with the VIX spiking where it has been up to 20 plus, it usually bodes pretty well for this particular strategy. So I started out this morning selling some premium, where right now out 45 days, it's pretty much like a textbook trade for me. If I go out 45 days, if we're somewhere in between this range, which is about a 7 to 8% swing, I still make money on the trade. So I thought about it this way. When we came into basically 6 days of selling last week, and we had that big rip up on Friday, I thought this was protecting the lows for right now. I mean, everyone is calling this the Trump put over the weekend, which I don't necessarily agree with. I think that Trump is going to be more vocal about the markets if they start to fall. I mean, case in point would be if we did make some fresh lows, President Trump will be vocal. I said this for the last month or so. I see this market this year as you've got, let's say the market's just driving along. I feel like Chris Farley and Tommy Boy when he's on that guy's desk and he's just like, blah, 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 blah. But the market's just riding along, and you have a guardrail and a guardrail. So the market's, swerving around and doing its thing, but you've got equities on one side, bonds on the other side. As long as nothing breaks, this market's just going to keep humming along. We're going to still have tariff threats. We're going to have these bargaining chips. You're going to see random tweets and just noise, right? It's a lot of noise. The market, I don't think, could all of a sudden flip and say, like, we're excited, we're going to all-time highs, because nothing really changed. All we did was have terrible bearish sentiment. That's a contrarian signal, but it doesn't mean that everybody has to jump in and load back up and be buying, because if we do that, we'll go right back up and hitting all-time highs, and it's going to be too bullish, and the market's going to flip again. So, but again, I mean, this could all change with, like, tariffs could be kicked down the road. This 10% tariff in China could be like, it's 10%. Who cares? 25% could be delayed in Europe or delayed in Mexico and Canada. Who knows? Everything's supposed to be going into effect right now, but it pretty much put a floor in the way I see. We filled the election gap on the S&P. We're using this pretty strong support level. It was also right down to the same low on Friday. I wasn't surprised to see that move like intraday. It was a crazy end of the month. And usually February kind of like shrugs off all of the flows. Like big leaps are expiring in December and January. There's a lot of option expirations in that December to January cycle. And so February is usually like, okay, what do we reassess? And so Mag 7 has been a big reason the market's been down. Nvidia crushed earnings, but it wasn't enough, right? Because it's like slowing the trend, and it's crushitude. It's slowing the trend, right? It's not exponentially. It's like the law of big numbers. Is it easier to make $1 billion to $2 billion or $100 billion to $200 billion? Well, it's obviously a lot harder to make $200 billion.
Yeah. So, Chris, correct me if I'm wrong. It sounds like you're actually kind of in the same camp as I am in terms of, sounds like, well, based on your positioning, that you're a little bit geared up for a range bound type of environment. And I actually feel pretty strongly that there's some good kind of cushion to both sides as you're talking about.
Yep.
And that, I think we could see lower prices, but I also see that there's probably big buy the dip, kind of movements out there. I think people sometimes will hear that and they say, well, you're just saying it could go both directions. And that is kind of what we're saying. But there's that clause of we see limited room in either direction. Is that kind of what you're thinking?
Yeah, I think limited room because it's not necessarily so bearish. And I'll say this, until we start to see cracks in the spread market, until I start to see like junk bonds, AAA, BCs, high yield, like if the credit spreads, which are as low as they've been since like 2007, which can be scary because we obviously know what happened in 2008. But until we start to see this market cracking, I think what we're experiencing right now is what needed to happen. I don't know if I can show a leverage ETF. This is probably just, everything's, you know what I'm saying? Like I want to get a reading of like, I'll try to find this, but there has to be it's another kind of sentiment indicator. But if you see that like everyone that's in loaded up like leverage ETFs or leverage instruments is now getting hit harder, like that type of trader has to get beat up. And that type of trader that's experienced a 4% or 5% flush that's now down 10, 15, 20%, that's the type of trader that like runs for safety, right?
Yeah.
And so I think this 4 to 5% correction we've seen in the markets is being it's being displayed like it's so much worse than it actually is. Like the index itself, I mean, to get a bearish sentiment reading that high, Nick, at a 4%, 5% correction is insane to me. But it just shows how much people are concentrating in Mag 7, concentrating in tech, concentrating in leveraged instruments, and that needs to get cleaned up. Like that's all this really is, in my opinion. So I'm not really bullish or bearish. I'm still trading with like this cautiously optimistic outlook, which is I'm building a lot of trades for this environment. If we have prices, navigating in here, that's fine. I'd still like, and you and I talked about this offline last week, but I'd still like to see maybe this market find this 200 moving average.
Yep.
And then I start to get more position for a bullish rally. Now that rally to me is really no better than going back to the all-time highs. In fact, that's probably what my plan is this year. So if I can time this market well enough where an entry into this area that gets back to all-time highs, I'm going to try to make, without obviously risking everything, I'm just going to make a decent amount of capital and be happy and also be protecting a lot of profit up there, because I don't know how this market necessarily goes 10, 20% higher than the all-time highs. There's just too much uncertainty and a lot of crap that can still happen in 2025 that's not that great.
You mentioned the 200-day moving average, and that, I guess, kind of sums up my thought here, is that if I look at this chart, first of all, I actually didn't realize how close we are now to the 200-day moving average. We did the old correct sideways. That is the most nice way of saying, a pullback, right? We've corrected sideways, quote unquote, because this market has gone sideways for a while, giving the moving averages a chance to catch up. My thought is that, you know what? I buy a 200-day moving average retest, but I also think in the short run, I think we're very likely to go test that, right? So like I said, Chris, I was mentioning this to Ivan, is over the weekend, I put together some videos sharing my thoughts, and a lot of people were on like, Nick, you're so bearish right now. And there is a difference between being outright bearish, which I think means you think it's going to break that 200-day and start seriously trending down, or what I actually would say is more just, as we always say on the channel, cautiously optimistic or cautiously bullish, which is this idea, look, markets have rolled over here a little bit. We aren't seeing this same every single day up by the dip every single time it happens. We're seeing dips sustain. We're seeing, for the first time, I would argue, for a little while, we've corrected sideways. Is it out of the question for this market to have one or two more kind of moves lower to test some long overdue areas to retest? No, I'm actually so bullish that I want prices, as you just pointed out, to work off some of this noise, some of this leverage, some of this over enthusiasm in this market. And then I think we push higher. Like, I think that the bigger theme is the bull run continues, but we need to have our 2023 10% correction, really reload the excitement about equities, and then we can push higher. But I think that when we've run for so long, we've stretched so far without any sort of good give back, flush out, if you will.
Yep.
It's like you got to take out the trash every once in a while and shake out the weak hands and let the diamond hand kind of people, do their thing. So I think the 200-day moving average is a pretty fair assessment, in my opinion, of where I think we will test. But hey, just because I think that doesn't mean we have to. If we start breaking structure, start breaking out again, look, I'm not smarter than the market. I don't claim to be, right? I'm trading the trends. I'm looking for opportunities. I think most likely we head back and we test areas. Could be a little ugly in the short run, but I think it gives us a chance to work off some overbought readings and to work off some of that leveraged. And, if somebody's down 25% in their portfolio, Chris, my question to them is what are you doing right now? If you're down 25% I'm not talking a trading account, I'm talking more like a portfolio. If you're in all the Palantirs, the Coinbase, the Bitcoin, the Ethereum, and your account's down 25%, hopefully this is a wake-up call. It happens every single generation of traders, right? I mean, you get a flush out and it humbles people and they're like, okay, I'm not doing that again. But you have to have those flush outs for people to learn their lesson and for this bull rally, in my opinion, to actually sustain itself long-term. We want healthy corrections to recalibrate and to go higher on good bearings that aren't so leveraged and so risky.
Agree. Let me ask you this. Let's look at a little bit further in the future. Let's say that we do see all-time highs again tested, let's say in the next 3 to 6 months. How much more bullish are you on the market for 2025 going into 2026? Just bullish or bearish? Like, do you think we sustain a bull market to the tune of another 10, 15%? We just came off of 20% years. Going to a third year of like, do we get a 15 to 20% rally this year?
So, the thing is, Chris, I think I have to default to what I know, which is I want to watch the sentiment indicators that we talk about so frequently. I want to watch the macro. If we rip through the highs, and it's because, the Atlanta Fed GDP now, I don't know if you saw that, actually signaled for the first time since 2022, negative GDP growth expectancy. So, those types of things, if you're hitting all-time highs with macro, which I would say is not bad, but not the kind of, overheating, excellent economy kind of outlook that we've had the last few years. If that's cooling and you're hitting all-time highs in price, I would argue that in that case, you might be seeing a divergence between the economy and stock market where I wouldn't trust that rally. Right. That's my opinion.
Yep. And also the thing to keep an eye on would be just labor data coming in later this year. Look, we have layoffs in tech. We're starting to see layoffs go into other companies. We've got a huge, massive layoff that's just happened in the federal government. So it's just been an interesting, the market is still navigating all that, right? Like, we basically chainsaw the federal government to, I'm trying to think, I listened to this over the weekend, and so let's say that Trump and Elon Musk with Doge, instead of just like finding budget items to fix and repair, they just fire people. But if we did that for the entire year and Doge cuts 500,000 federal jobs or 800,000 federal jobs, all that's really doing is just taking back everything that the Biden administration did for the last year. It's just like all the fluffy federal jobs that were a huge point of growth, like growth last year in jobs, government, healthcare, and services industry. That's it. So if we gut, a third of that or more so, because there's probably more government jobs than anything else the last couple of years. I don't know what that looks like as far as like overall, state of the economy. I think, like you said, that's the divergence between Wall Street says one thing, Main Street shows another thing. And then on top of that, you layer in, we talked about this last week, the consumer that is still spending money is the higher end earner. Yes. Right? Like 50% of all spending right now is done by the top 10%. You go to the top 20% of demographics. So whoever is the top 20% of earners, that's about 60% of all spending in the country. So if that demographic is hurt, where and here's how they're going to be hurt: the stock market drops, that segment is hurt more. Because those, what is it? Top 10% now own like 87% of stocks or something ridiculous like that.
They're the ones that have portfolios, period.
Exactly. So they, as far as like where they spend money, what they're spending money on, when they spend money, it will completely be associated and correlated to what this stock market is doing. If we're continuing to stay near all-time highs, consumers healthy, people that have, most of the country right now is sitting like, I think 70+% of mortgages are all like 6% or less, or 5% or less, or 4% or less. Like, it's crazy how low mortgages are in the country.
I I got to tell you a quick story, Chris, because it goes with what you were just saying. In college, one of my really close friends, we traded stocks, invested in stocks together all the time. We talk about, different companies. He was so funny because we had a certain class together, and he would come to the class or not show up to the class based on what stocks were doing that day. And I don't even know if he was consciously doing it, but it plays into exactly what you're saying, because if the stock market was up that day, there's a good chance he would just skip the class. And if the stock market was down, he would come in. He wasn't doing it on purpose, but I told him about it, and he's like, oh my gosh, I do that. And that is exactly what you're pointing out. When portfolios are up, people feel good. They spend more. They're less scared. And in his case, when portfolio was up, he's like, I don't need school. And when it was down, he's like, I need school. But I thought it was a good comparison to what you're pointing out is, look, people have a portfolio up or down feeling that they carry with them in their spending. And so especially that upper echelon of consumers, if they're feeling good, if their portfolios are all screaming higher, they're going to go on vacation. They're going to go buy a second house. They're going to go buy a car. They're going to go, put money down on something. So it's really a really powerful force. Is if stock markets are up or down, it causes sentiment to go up or down with it at the most critical level of the consumer.
Yeah. And I think that what we're going to see sentiment wise is we're going to see more extremes. And honestly, with Trump as president, this administration, I'd say extremes are probably maybe noisier and overstated than what they really will be, which is why over the weekend I was running the test of like, okay, look, if this VIX, I mean, in 2022, we had a bear market in 2022. Everybody felt it. It wasn't the easiest market to trade, but it also came with some pretty nice bounces, right? I mean, we had a flush down, then a bounce, 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 flush down again. And then we actually established that it was a 9-month bear market because we're making lower highs and lower lows. But if you were timing this, like every flush down was met with a pretty nice rally. And so I think over the next, let's say 30 to 60 days, let's just say 30 days, if we actually see the market, stabilize off of those lows from February, literally like February 28th is a good reference point. If we stabilize off those lows, that's fine. But we don't necessarily break the highs. We don't necessarily flush lower. And there's a lot of option trading that can be done when you have higher volatility, selling that premium. The actual move is far less than the expected move because volatility is so much higher, right? When the VIX is higher and you're selling premium, you're typically taking advantage of that difference between the expected move, which is usually overstated, and the actual move, which is going to be much less, which is why that's exactly what I did this morning, which is sell a bunch of premium. And that's what I'm going to continue to do. And it's all going to be risk defined. I mean, I know that if you're thinking selling premium, like just sell a bunch of puts and just do strangles and sell, it's all defined risk for me. I know, because that way, if there is an
Iron
outlier,
condors and things like that.
yeah, like iron condors, and I do like synthetics where it's like a little bit wider. So like a 20 wide or 30 wide iron condor is almost treated like a strangle as far as the credit you receive. So instead of getting $5 of credit, I get $4.20 of credit. And so I'll sacrifice the 80 cents, but it treats it much the same way. And if we have an outlier event, I'm not stuck with that like crazy undefined risk that and I see too many equity curves that happens to, right? You can do everything right for months and months and months and make all this consistent income, and then one July to August, like we had last year, then all of a sudden people's accounts look like that.
Yep.
Because of undefined risk. And so if I can cap that undefined risk, it's like, look, I'll risk, $1,000 here, a couple $1,000 here. And that's the worst I can lose. That's a lot better off than like, oh my God, I'm down, 3, 4, 500% on my puts.
For that outlier VIX move. Yeah.
Exactly. For that outlier. And speaking of that, I mean, that's what last year was. If I'm taking anything away from last year, it was, I know the market was a bull market. I know we had hiccup in April, in August, and briefly right after Labor Day, and then December was no picnic and it wasn't a Santa rally. But that showed us how sensitive this market has become when it's like VIX events. We had 2 of the largest VIX single day moves ever. And on top of that, right now, Nick, this is one thing that does make me a little bit nervous going into the next, let's say 12 months or so, is there are so many instruments now that traders can trade that I'm not saying this is going to ruin liquidity, but it does make me nervous when everyone is trading. And I'm putting everyone in like light terms here, but everybody could, if they wanted to, trade just leverage instruments. Everybody. And so instead of trading the SPY, what if you traded always double X? leverage. And if instead of trading Nvidia all by itself, what if you just traded double X Nvidia? Instead of Bitcoin, you traded double X, or MicroStrategy traded double? It's like, that's crazy to me, that just trade the underlying, which is already crazy enough. Like,
Yeah, there's
Bitcoin's
enough
already
movement
volatile enough.
there.
MicroStrategy is already crazy enough. Nvidia is already going to be crazy enough. But when
Yeah.
people are just going into leverage instruments, I just think that it's like that flow on the peripherals, and the flow is all those extra derivatives, makes it where there's not really liquidity everywhere if it's being spread out like over all these other layered instruments. Does that make sense?
Yeah, no, it does.
So,
You
but at
got to
some
be
point
careful with that
they're going to
stuff.
get busted up. Like, levered anything is going to, it works for you and works against you. And I think that's the one
Exactly.
part about this year that's going to be so challenging, is everyone that's levered looking for direction is probably going to lose. I don't see this market giving us a ton of clear direction, and that's how I'm trading. That's what it sounds like you're trading, and I'd rather take advantage of a trader's market that's not really giving us any direction. And this is, again, kind of a testament of, like, who's traded through stuff like this before? Because I have, and you've seen like booms and busts in the last 6+ years. You've been trading for almost 10 years, right?
Mhm.
So I mean,
Yep.
we've seen a lot, and I know that the market doesn't have to always go directionally up, directionally down. The market this year could be so uncertain about where it wants to go, where it can go, that it's going to be like a 2015, 2016. We're going to have like these maybe 10, 15% swings. And, when we come to like an extreme low, it's like sentiment's going to blast all these readings and everyone's bearish, and it's a buy signal. And then it goes
Yeah.
too high, and it's like, we can't really justify these valuations. It's going to be sell signal. This American exceptionalism, or this exuberance that America has experienced, like, we've had the best market for a decade. We've been outpacing Europe by 3 standard deviations. Well, look at how assets are performing this year. Non-US is kicking the crap out of US right now.
Yep.
But I'm
That's
not going to
true.
chase. Are you chasing like European stocks or European indexes or China right now? Like, I'm not chasing anything.
No, I'd like some China exposure, but I can't
Yeah.
justify where it's at. I mean, that's the thing, Chris. I agree with you. I'm definitely more on the sell premium this year train. And I still like metals. I think there's some good in that, all that indecisiveness. I like metals, right?
Yep.
There's that
Yep.
little bit of a kind of upside move there that I like. So, that's where I'm pretty positioned. I like metals this year. I like selling premium this year. I think that there's some bigger discounts coming for stocks. And if they happen, I'd be cheering the opportunity to buy some things at lower prices that I've been watching for a long time. So,
Yeah.
Chris, I'm gonna back out. I'm gonna give you the floor here for 15, 30 minutes, however long you'd like to go, take over. Before I step out, let me just remind everybody, if you are interested in the Edge Finder, we're currently doing a 35% off discount this week. You can get access to all of our different market scanning software, the AAII Investor Sentiment Surveys, Commitment of Traders Report, the Economic Heat Map that I spent all weekend refining and updating. Chris, by the way, this is the new Economic Heat Map, completely overhauled, got your actual previous forecast, and I'm working on this number, actually populating blue or red based on where it's at, right? So if manufacturing PMIs are in a decent level, or services PMIs, inflation, is it hot, right? So PCE is okay. That's why it's not blue or red. But then you have CPI, a little hot, so it's in the red camp. So just giving people a little bit more of a for those who are newer to macro but just want to understand, where's the Fed going to go based on what we see here. That's kind of the ultimate point of the heat map. We've added that new feature. Like I just said, Edge Finder is currently 35% off for a limited time. If you'd like some information about that discount, please send us a direct message using the link just been dropped in the chat, or in the description down below if you're watching this at a later point. Chris, thank you very much for the conversation, man. Good speaking with you, and we'll see you back on the next one.
All right. Sounds good. Thanks, Nick.
See ya.
Cool. I'm going to go for another probably 13 minutes, everybody. Let's get through some top down. So nice little P&L day. Had a nice recovery on Friday. Like I said, I know my watermark for the year is around 195. Trading around 130 right now as far as P&L for the year. So like I said, I sold a bunch of premium. I probably have, right now, this is going to be an interesting couple of weeks, because what I'm liking right now, as far as just on a personal note, we've seen a big drop in the 10-year yield. We saw the dollar reverse in a big way, which I think is really interesting. That's a lot of volatility here in the dollar, by the way. So we catch a bid down here around that 106 handle, and we just get flushed today. I'm totally okay with that. And then obviously I like seeing the 10-year yield dropping to get back to normal. I don't know if we necessarily flush all the way down here. This would be screaming, Fed is anticipated right now to do 3 cuts this year. I don't know if anyone saw that last week, but that's been the big change. So the CME watch tool going into probabilities, Right now, this is, I've taken so many old screenshots of this. Let me see if I have one. Let's go downloads Fed. Okay, so this would have been February 6th and February 7th. Let me see which one this is. Okay, here is a screenshot of February 6th. So just over a month ago, right? Or just around a month ago. This was anticipating one cut, maybe two. Okay, so that one cut was coming in June with a decent probability. And then we have another one coming at the end of the year. So that was going to be our 1 to 2 cuts for 2025. Well, now we look at the present, and now we have way less time in between and more of a probability that June is now a pretty substantial gain, where that probability is now 54, almost 55%. So that's one cut coming in June, another one that gets a slight edge in September right here, and then another one by the end of the year in December. And you know, December is kind of a toss up. It's kind of sprinkled in all over the place, like 30% for a cut, 29% for a pause. But you can see that the progress has been being made, where 1, 2, and 3 cuts are now anticipated. Now, if the market is pricing this in, that should bring U.S. 10-year yields lower. If that is the case, and I'm actually liking this right now because I'm in the market for a house and I want to see how low I can get these interest rates. And right now, by the time I'm closing in the house, is probably about a 40 to 60-day window. The more to the downside, the better. I'm actually going to be pretty stoked to see that is the case. But I'm also aware that, you know, now everything moves in a straight line. So this goes high, low, lower, high, lower, low, maybe lower, high, lower, low if I'm lucky. I don't know if we're necessarily going all the way back down here. When we were sitting at 3.6% in the 10-year, the average mortgage was around 6.05%. When we ripped up here and did the complete opposite, the average mortgage was around 7.5%. So as we've come back about 50 to 60 basis points, this average should be around like 6.5%. So I'm going to play the numbers here, and I'm hoping that if I'm talking to servicers for a new home, that I can get a 6.5 or better rate. And I'll probably still do a buy down. I'm going to try to get as low as I can to this 6%. And I know that still sucks. I mean, I sold a home at 3.5% interest rate. I sold a home at 2.7% interest rate. Now that I'm considering a new home at 6.05, I'm actually like sick about that. It's fine, but it's like, geez, I'm gonna have to, make an extra 1 or 2 payments a year, just try to outpace the inflation, or not the inflation, but the interest rate. So it sucks. I think it's in a horrible situation where the market is pretty much frozen. We'll have supply catch up. Another thing to check for on the economy would be residential construction. And if homes are still being built to have supply, you got to wonder what's going to happen in the housing market in the next like 12 months. Is there going to be so much supply that's sitting there stagnant and not selling because nobody can afford to own a house at 6-7%? Well, they're going to have to either drop prices or rates are going to have to come down. The only way this market gets more affordable is rates come down or homes get cheaper. Obviously, people that have equity in their homes don't want to see cheaper homes. So the happy medium, in my opinion, would be most of the country would be willing to move and buy more properties or whatever if their rates come down, right? Because people have a boatload of cash in their homes right now, probably more so than they really need, probably more so than they should really have, because the housing market in a 3 to 5 year period should not double in price. That's crazy amounts of asset appreciation in a market that really doesn't do that. I mean, really, a home is meant to build equity. If I buy a home for $500,000 and it maintains its worth at $500,000, but I'm paying it off every month and I'm getting more equity. But now it's like I bought a home at $500,000. It's appraised at $1 million. That's only if somebody's willing to buy it at $1 million. And so either that like fluffy appraisal comes down and people are losing value in their homes, but now everyone's going to be pissed about that, or supply catches up and we see that rates can go down and make things a little bit more affordable from that standpoint. To be determined. Okay. Anyway, that's where I'm at. Top down, let's just take a look at everything. Heat map wise, I mean, we had a pretty big comeback on Monday. Risk assets, let's take a look at Bitcoin and index wise. So, S&P, let's just go SPY here. Still trading in between. I know my charts are really messy right now, but basically my trades are this. If we're not breaking highs, I'm selling premium. If we're not breaking lows, I'm selling premium. If we're in the middle, I'm making money. That's pretty much my strategy right now. I may actually look out and do some additional strategies on the call side. I think that this market is going to be struggling to make like all-time highs that are substantial. So I might look at adding in some call condor strategies this week. I still like equal weighted quite a bit, RSP and QQQE. This is another one on the Qs I'm actually watching pretty closely. The QQQ did come close to the 200 moving average. This is another one I still think gets tested. The longer it goes, I mean, here's one thing we did do. So this little flush from high to low in the Qs did take out a low, did take out a low, did take out a lows. It took out a series of structural lows here that to me, if we go up, I could see a lower high and a lower low. And that little correction, some type of flush out, would still offer up the buying opportunity to see if we get back to the highs. So I'm not necessarily jumping in crazy bullish yet, just in case this is a bit of a relief rally, but a dead cat bounce and the market's not quite done pricing in anything bad, right? Like this was a good correction, July to April, or I'm sorry, July to August. April was a good correction last year. September briefly was a correction. December was moderate but low volume, you know. So if we have a real correction, high, low, lower, high, lower, low, it's in this environment that I say, okay, I like taking a stab at this, trying to get back to the highs again, make a decent amount of gains, but be very protective. If we can get an opportunity to position ourselves for a low to high run, and we get back to these highs, I would be really happy with that being like one of my best trades directionally for the year. And then going to 2026, I'm way more braced for uncertainty, even more downside, because the longer this takes, let's say, and there's a couple ways this plays out. Let's say that we get some high, low, lower, high, lower, low, and then we work our way back to the highs. Well, this is either working out one of two ways. This is either setting up for some like monster bullish pattern here that then breaks and goes higher and we're still making all-time highs, or my concern is that we struggle so hard to get to these valuations and maintain and justify these valuations that all this is going to do is carve out this monster rounded top, and this market's going to end up rolling over on itself. That's probably my biggest concern for 2026. If interest rates don't get better, if inflation is not truly improving, 2026, I've said this literally for the last like 3 years, like I don't know how consumers are stretched this far and this thin without finally like going broke. I mean, life is more expensive. It feels that way. I don't know how anybody's arguing the fact that it's like, oh, things are great. Things are great if you own a home and your home is worth twice what you bought it for. Things feel good, right? If your stock portfolio or whatever your portfolio is, if it's up, triple digits for the last couple of years because the market's been pretty, it's been a great vehicle to trade, right? But at some point, the market and the stock market and the real economy, they match at some point. So if Main Street is feeling recession and jobs are being lost, and that's another thing too. It's like if the markets are dropping, we're probably getting job losses. And I don't know which one leads, right? Which one is the tail wags the dog? Maybe. Does the economy lead as a real economy lead, or is it just the market crashes first and then everything else starts to fall in place? I don't know. But I'm not super optimistic for 2026. I think the market's going to have a lot of pain ahead. And I say that to this degree. I mean, I don't think this is unreasonable, but this blue line that I have here, I talked about this a lot last week, just kind of get traders positioned for like, look, we can have some wild and crazy stuff happen here. I think that the market is fine holding April, August lows, and then possibly coming back to this dip area. I also see that what happened in 2022 with our bear market is we came right down and tested a 5-period yearly moving average. 2020's COVID crash was a 5-period moving average. So on my daily time frame, if I go out, we had this big ridiculous stretch from like 2010. We tested it in 2011. We tested it in 2015. We tested it close in 2018, but not quite there, but then certainly tested it in 2020. This 5-period yearly moving average doesn't go more than like 2 or 3 years without getting tested, usually, historically speaking. So go back, 50 to 70 years, usually within about a 2 to 3 year window, this gets tested. Look at the spacing that we have, right? It tested. So I could see this sideways like garbage market right now where it's all sorts of back and forth. You got to be an income trader to generate positive returns this year. But I could see this whole thing topping out, rolling over, finding this, we're talking about a 20+% correction. That would be a healthy correction. Now, the question is, do we bounce from there, or is it worse? Because what we don't spend a lot of time doing and haven't spent a lot of time doing is, you notice how this isn't below this 5-period moving average? The market usually finds it and then rips off of it. But if we get below it and stay below it, that's when, that's ugly. That would be ugly. The last time that happened would have been in literally 2008. That would have been the great financial crisis, right? So there's your .com bubble that we got below it. I can't go back any further because I don't have data here. But through this crash in 2000, 2001, we were below the 200 or the 5-period yearly moving average and stayed there for years. And then back in 2000, 7, 8, 9, same thing. We got below it and it took us a couple years to build back. That was 2008. It took us all the way to a year later, we get back to it. Now, I would say that that'd be my target. And I'm just talking future stuff here. So right now, I think the market is survive. Survive, survive, survive. Not really major highs, not really major lows. It's going to drive directional traders crazy. But eventually, if and when we hit this 200 move or this 5-period yearly moving average, this becomes a buy level to dollar cost average. Anything below that by another 5%, 10%, 15%, 20%. To me, that is a bargaining price. Where I think this is a heavy discount. So not only do we have a correction to get there, but anything below it, any 5% increment below it, I'm going to be averaging more in. Because at some point I believe it'll take time, but we will get back to those highs again. And so if we're below this and we get back to it, we get through it and we get back to all-time highs again, the amount of gains and wealth generation there, if you're future thinking, can be substantial. So anyway, just food for thought. I'll plant that seed out there for the next 1 or 2 years, but we'll also digest it day by day too. So, all right. That being said, let me just do a quick top down again. Nasdaq, I'm looking to see if we have, because we did flush down, we didn't quite hit the 200 moving average, which I'm still going to watch closely. If we go high, low, lower, high, lower, low, this is where I'm going to scoop up my cues and my positioning. Look to see if we get back to the highs. I like that trade quite a bit for 2025. I still like equal weighted as well. This one also very close to hitting the 200. I still have some shares in here. The Dow, still like the Dow, but not there yet. We still need to hit this bar count. So we could come back in and fill this gap, but not break the highs. I'd still see this thing maybe sideways, right? Finding the 200 moving average, get positioned for a dip on that 200 moving average on the Dow. The Russell, I'm staying out of for right now. I still like IWD and IWX better. That's value and dividend play. VIX is still up a little bit. So we're in the 20s now. I think this is a good time to be selling premium. Dollar index crashing hard, which is totally great. I think there's still support around the 106 to 105 area. Oil, maybe a bull put spread in my future. That's about it. I've got to hit this chart alarm first. Natural gas still hanging in there. That's a diagonal spread out to 2027. Gold catching a little bit of a bid just below the 21 moving average, though. That's an aggressive move. I'm still not there yet. I think this is high, low, lower, high, lower, low, coming back to at least the 50 period. I look to see if gold can at least come back to the 50 period. So I'm not jumping in on gold yet. Silver, obviously a nice little turnaround, still well supported by all these dynamic moving averages. Bitcoin, ridiculous move, 78K all the way up to 95K. I know there's a crypto summit. There's some optimism getting pumped back into the markets. This administration is pro crypto, and the crypto community likes it so far. However, resistance. I mean, right now this is pretty easy. You want to buy the dip. You think you can buy the dip, but until this thing kind of bottoms out, I'd say we're gonna have to wait longer. I think just like with the markets, if there's uncertainty in the markets with direction, how can we think here that Bitcoin's going to give us really any clear direction? So I think if Bitcoin stays, 75K is kind of the low end and 108K is the high end. If you're accumulating at the lower end here, that's good, because eventually if we get to the highs or higher, that's a nice spot to be saying, okay, I've added some exposure here and now there's some good upside potential. But I wouldn't be like crazy bullish and tossing money at this simply because nobody knows, So on that note, I mean, some of those wild and crazy ones like Bitcoin translates into, okay, Coinbase was up to 230. Now it's down to 218. I've got some spreads out here into this month. We'll see what flows do. MicroStrategy was up to 294. Now it's gapping. It's gapped up to 294, then back down. So, not really much follow through on it right now. Copper stable. I like this 111 trade that I have in copper. Japanese yen has pulled back. I'm actually glad that I took the profit near these highs. I'm still holding FXY long. DAX, oh my gosh, you got to be kidding me. This is fine. I'm long FEZ, but good Lord. Just European stocks are just nuts, man. Wow. DAX is just ripping like crazy. FTSE ripping like crazy. Sheesh. That is some non-US money play right there. Right? Like that is like, look, US is overvalued. Where's undervalued? Europe. Europe is undervalued. Nobody wants to own Europe. Boom. I mean, this has been relentless. It is doing awesome this year. So DAX is up. FEZ is an instrument that allows me to trade similar to DAX movement. FTSE also making some fresh highs. Crazy stuff. China stalling around the September high from 2024. Brazil pulled back a little bit. I'm still long Brazil if I want to be long inflation. The MAGs, this is a nice little ETF to trade as well. Just watching to see how this plays out. There could be some buying interest here around the 200 moving average. I think there's good structure on MAGs. This is part of the reason the market's been down. The other thing that's nice about the index is, think about this. MAGs is down 15, almost 16%. The S&P is down 5 or 6%. 5%, not even 5%. I mean, I said this like this year. If I want to eliminate volatility from our portfolio, I need to focus on indexes, not individual stocks. Mag 7, arguably the safest basket of high appreciated stocks we've ever seen, right? I mean, they've had a fantastic decade plus run. If you didn't have Mag 7, you missed out. Okay, but a 15% pullback in the mags cumulative, or the aggregate, Nvidia's had 20+% swings. Amazon was down over 20%. Tesla's down 40%. Meta's pulled back 10-15%. There's a lot more volatility there. And the crazy part, if you look back to 2022, that's how bad it can get. Meta and Tesla were down 70+%, and now they're at all-time highs and everyone loves them and they're the greatest stocks ever. But I'm trying to eliminate a bunch of volatility this year. Seriously. So I think this is still a necessary rotation. This helps broaden out the market. And I said this early this year. If the market's going to broaden out, we can broaden out by going 490 plus stocks performing well, or the top concentrated stocks perform poorly, and then that money gets dumped and concentrated into the beat up stocks that haven't been performing well. So it's kind of that second camp, is that markets on the Mag 7 side people have been leaving and vacating because it's so concentrated. So they're going elsewhere. So Mag's down, but meanwhile there's a broadening where we're buying more financials and utilities and more defensive stocks and staples and things like that. So other sectors are picking up some of the weight. Bonds have come back up this year, which is pretty nice. So anyway, just stuff to consider. Speaking of Mag 7, Apple's still hanging in there. Amazon looking a little bit better. I've got some ratio spreads on Amazon. Google, I'm just dollar cost averaging in with a bunch of income trades out in the lows around 150. Meta, I still think is going to have room to drop. This is another spot where if we go high, low, a little bit of indecision, high, low, lower, high, lower, low. I think Meta needs a correction. This is one of the larger bar counts that I have. I think this is a good spot to say, okay, I'll throw some position in there, but that's not a huge pullback. It's really not. If we went high, low, lower, high, lower, low, I'm curious how that times out to get back to these highs. So I took profit in this one last week. That one's done. That was a broke wing butterfly. So that was a winner. Anyway, Microsoft still holding pretty well about that 400 handle. A lot of my ratio spreads are below that. So this one's closer, but 375 seems a little bit safer. Hopefully we're not making too much lower lows for the next couple of weeks. These are some income trades here for another $1.20 and $2.40. Netflix, I still want to see some Netflix down to this 200 moving average. I've got some income trades there as well. Nvidia, I think if you're interested in Nvidia, selling some puts, if you can afford to own the shares, like I'm doing some credit spreads, ratio spreads. A wheel strategy is one thing to consider. Just sell a put. If you get assigned, then sell a bunch of covered calls and you'll repair it. I'm pretty confident we're not going too much lower than probably like $100 to $90 would be like my lows. I sold a bunch of puts at 70 and 75, which are probably going to expire for full profit. I don't think we're necessarily ripping up here to 155 anytime soon. But I do think that this low from August here, so this resistance becomes support. I think that area right around $100 is pretty firm. We still have this kind of choppy zone as well, where we could have this eventually, like maybe below the highs off, maybe. But again, I think when you have large stocks that are still in these big ranges, you're going to have large ranges to trade. Tesla 296. Working a little bit better off the lows, which is fine. I've got a couple dollar cost average positions in. This is full profit. This one's a monthly expiration here. We'd have to get below 255, but it's still another income trade. If I own shares, I will own shares. I'm going to own shares of Tesla, repair it, but there's no assignment on it right now. Not that I know of. Let me double check my portfolio here. I don't think anything got assigned on Tesla, but I will double check. Tesla, just partial shares, but no assignment. These are all like one contract ratio spreads. So if I have 100 shares in here, it's because of a ratio spread assignment, but we're not below my strike prices. So no assignment yet. Berkshire Hathaway, Warren Buffett with his massive stockpile of cash, one of the biggest on record at Berkshire Hathaway. The stock itself is up at all-time highs. I mean, I think if you ask Warren Buffett right now, he probably wouldn't even buy his own stock. He thinks it's also overvalued. So I'm pretty sure Berkshire is going to continue to build a war chest and get ready for a buying spree when it's time. And I don't think that time is now. And then bonds are fine. I've got this $27 max profit on bonds. And check this right here. So TLT, I looked at this last Friday. TLT, I've got a $27 max profit, and I'm trading for around $25.05. Now, I still have this trade out to the end of April. I don't have to do anything here other than wait. If it gets called away, it gets called away at $27. I still make around $2,400 per account. So it's a good trade if we're greater than 92. If we pull back and fill some of this gap, my concern is that this pulls back and then yields go back up. So I'd almost like to see the bond market rally and yields continue to soften. And then that looks better just to get called away. I'll just take the winner and move on. Okay. All right. 10-year, like I said, 10-year is heading lower. I like all the red, but I mean, obviously I see charts just like you do. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. There's 10 candles red. I don't see this necessarily being sustainable. I think we're probably going to pop back up here in the short term. I'd obviously like to see it flush lower, but I could see the 10-year yield pushing back up, which means that bond prices will be dropping a little bit. Okay. All right. That being said, JD still running with this one above $40. Alibaba is still above the crazy rip we saw above the high September. I got out of the stock. I still have some option trades. Baidu just can't catch a bid, man. I think Baidu just needs to come out and say, we also like AI, and then see if they go up to these September highs. I still have Baidu. I'm still in it. I'm collared out here to April for the 100 to 105. I might just end up generating income on that collar and then just repositioning it. I'm out of FXI, out of KWeb. I'm still in JD holding some shares. SCHD, I like it more so than SCHG. This is Schwab dividend versus Schwab growth. I like dividends a lot more. I like the Dow. And then I've got some other stocks here that all have carved out some highs. So Costco recently carved out some highs. This one was a trade. I think I took this trade off already. This one was a full profit last week. Costco last week is here. Yep. So this is an income trade that's currently up about $400. Cool. Yeah, I'm just gonna hang on to that one. That expires. Oh, that's a lead. Okay, I'm gonna the 111 trade. I might just close this whole thing down. All right, that's a pretty good gain. All right, anyway, that's it. 650. I mean, that's so far down here. We'd have to have like just a monster implosion if I'm down here at 600. Anyway, Walmart, fine, probably sideways. The high might be in for the interim. Nike, fine, $65 and $60 puts. Home Depot and Lowe's staying out of for right now. MasterCard, Visa still making highs. Amex, it's crazy what credit card companies are still doing. They're still making all-time highs. Johnson & Johnson Healthcare came back in a big way. Progressive at all-time highs. CB, this is Chubb. This is another insurance play. This is Warren Buffett's kind of darling, as well as I think Progressive or Geico, one of the two. But nice income trade there. Palantir, not touching it at all. Got some ratio spreads out to April and May, but they're way down here in the $40. Carvana, I don't care. Let it fall. Salesforce falling. I'll wait. So there's just stuff I got to look at. There's some earnings this week that I want to be mindful of. Got it right here. Earnings this week that I'll be looking at. We've got OKTA aftermarket, Target. It's a lot of retail stuff this week. So kind of getting a sense, assessment of where the consumer's at. How much are they getting in sales? Have they seen less traffic in the stores? I mean, I'm curious what these overall assessments look like. So Target, big retailer, Best Buy, big retailer, Nordstrom, AutoZone for car part, Ross, Foot Locker, Abercrombie and Fitch. Let's see here. Kroger for groceries, Costco and BJ's. Those are wholesale, member groceries / other items. But this is a big kind of retail and consumer week as far as the health of the consumer. And again, like we said earlier, is it the top 10% still spending money? The top 10 or 20% still spending money? Are they affected? So far, the market's just sitting here at all-time highs. So yeah, probably fine, probably resilient. And also keep in mind these are Q4 earnings, which I'm sure were okay, right? So it's a little bit different as we get into Q2 of this year and we're talking about Q1 earnings. Things might be a little bit different, right? UNH. Yeah, that was. I mean, I don't know. It's okay, but I've chosen Johnson & Johnson for. I think this is possibly a range trade, but what would make me nervous would be this. I think UNH is more of a sentiment play than it is an actual technical. I think technically speaking, like this is a pretty good spot to be long. At least some resiliency back into like the 530 to 540 area. I just don't know if it's going to be, highs and lows and we just get ranges. Is this a stock that I want to own? Well, let's take a look. It probably checks a lot of boxes, and I'm going to wrap things up here in just a minute. But UNH. So profit margins lower than last year, still way below estimated value, reliable dividend, earnings forecast to grow, high level of debt. Okay, fine, but we're cutting rates. Price to earnings, that's a little on the high side for healthcare. But I mean, come on, man. Like discounted cash flow wise, it's like they're in the business. Like Humana, a little bit lower. We can take a look, but this is like one of the biggest healthcare plays ever. I think this actually is one of the bigger weightings of like the healthcare sector. So yeah, I mean, for right now, it's probably not a bad trade. Let me see what the IV is at. So UNH, this could be just a simple income trade. IV's at 63. It's pretty good. Now, again, I want to consider doing something like this with defined risk. Could I price? I don't know what the option premiums will be, but let me see if I can price this out. So if I go UNH, go out to maybe this. So the earnings play, pre-earnings, post-earnings, 45 days is kind of perfect. Maybe a profit trap in here if I really like it. So what I don't love is I've got to go 10 wide on the strikes, which is going to make this a difficult trade for me to price out the way I want. So let me try one more. So April. Nope, this is $5 wide. This might be a little bit better. If I buy a, let's say 20. So 5 wide at 20 delta, and then sell a, like that's not a bad trade. Not a bad trade. Do we go from 470 down to 400? That 400 is only an 8 delta. It's about a 95% chance of profit. Even before this is pre-earnings. Pre-earnings, yeah, I mean that's pre-earnings. I actually like that trade. I think the pre-earnings is fine. So I think I might take this trade. Yeah, I like this trade actually. So if I want to go a little bit higher up here for a profit trap, I pull in 40 cents. Nope, that's not going to do it. So a 430 by 435. Interesting. I almost wonder if my open interest is so low here, like maybe this isn't very liquid. 344 credit to $1.60 credit to an 18-cent debit. If I can get $1.50 or better, I might take this trade. It's only $1,500 of buying power. If I had to take on the assignment, I could. You're getting like $30 to $40 for a covered call. Now I take that back, about $15 to $20 for a covered call at the money, which is a pretty easy repair. If I took on any assignment below $400, we'd have to have a monster move. That would be well outside of a standard deviation. Like that'd be like a 2 standard deviation move to the downside. $400 would be down here. So United Health Group would have to be down 37% from the all-time highs. Anything is possible. But I don't know. It's not a bad trade. I'm going to kick it around. I might take this trade. UNH, April 11. And it's the 440 by 435. I'm just going to write it down so I can pull it later and see if I want to take the trade. And then the 440 sell put. Okay. So if I can get $1.50 or better, that'd be pretty good. I'd take that for an income trade. All right, that being said, I'm going to go. UHS. What is UHS? Health Services. I mean, just at a glance, I'd just say it's pulling back into resistance. Resistance becoming support right on this 160 handle. Not a bad spot. 160 is pretty good technical support. So finding some past resistance to become support, positioning for a bounce, see what it looks like as far as fundamentals. Is it due to grow? How's the cash flow? How's the debt position? Yeah, take a look. UHS. I mean, checks a lot of boxes. Price to earnings, not terribly expensive. Fair value discounted cash flow looks good. How's it compared to its peers? Way below its peers. Peer average 15.3, price to earnings is 10. Yeah, not bad. Put that on the map. UHS as well. Okay. I'll let you go for today. See you soon. See you tomorrow. Bye.
Thanks for watching today's A1 Trading Show. Be sure to subscribe and to turn on notifications so you don't miss the next one. Want more from A1 Trading? Check out the links in the description below or our website a1trading.com. We have lots of free trading tools and channels available for you. We hope you have a great rest of your day, and we'll see you tomorrow.